This is the London Fintech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is London Fintech Podcast, episode 13. And I'm desperately trying not to think of Apollo 13 or the 13 disciples. I've heard it's bad luck to be superstitious. I'm delighted to be in conversation today with Christian Faes, CEO of Lendinvest. Their aim is to change the whole concept of a mortgage, from how you get one to how mortgages are funded. Currently, they offer bridging finance from 1 month to 1 year and have recently added a 1 to 3 year buy-to-let mortgage product. Lendinvest is a company I recently heard described as the best dark horse bet for London's first major fintech IPO. They have certainly been one of my favourite fintechs for quite some time. Their simple, clear proposition and website, sadly all too rare in fintech in 2014, is up there with TransferWise, something that after a glance you'd get it and could tell your neighbour about. Why am I delighted? Firstly, the importance of the P2P sector. After 6 months continuously doing nothing, actually I shall leave it at that. After 6 months continuously doing nothing, full stop, but actually I had written, doing nothing other than hanging out on the London fintech scene, I believe that P2P is the most exciting sector in fintech by far in terms of near-term impact as competition for the old financial services and as choice for consumers. Peer-to-peer has more than doubled in size from 2012 to 2013 and from 2013 to 2014. Secondly, if we go down the debt side of alternative finance, we have the major subsectors of consumer, SME, invoices and real estate. Real estate has immense potential. And, as we shall see, there are huge market anomalies right now, which is code for saying there are fantastic opportunities for both borrowers and lenders. For the lender, which you could be in this case if you're a spare 10 grand or so, it is an asset class which in Lendinvest's case is around 60% loan-to-value loans, which are from 1 month to 3 years. Returns from these very secured loans are over 6%. In one incarnation or another, they have been lending since 2008 with no capital losses at all. Thirdly, in the Alt-Fi Awards, Lendinvest was ranked as the best UK fintech real estate platform. Fourthly, Lendinvest is a solid business. They have done £166 million to date. Solid businesses are all too rare on the fintech scene right now. They were the world's first live real estate platform and are now the largest peer-to-peer marketplace for real estate mortgages worldwide. Above and beyond all of that, Christian is both a top bloke, but also someone who has the gravitas and smarts of what I would call a real CEO. In a world where most everyone can call themselves a CEO of something, that's very rare. So I'm here at Lendinvest Tyres in London's West End, busy being ever so humble. If I had a forelock, I would tug it. Jokes aside, in the world of fintech froth that has been 2014, Lendinvest and Christian are the real deal. So I'm sure there'll be plenty of lessons today for UK fintechs in general, as well as on the peer-to-peer sector and on the peer-to-peer real estate subsector. So let's get on with the show. Hi Christian, thanks for joining me on the show today.
Thank you very much, Mike. That's a very flattering introduction, and I think your listeners should know that I didn't pay you anything to say those kind words.
That's really good, because when you did pay me to say the kind words, I then paid you some of the money back just to say that you didn't say it.
Well, we do give good returns, so yeah.
Oh, very good. Don't do that. That's a painful joke. So we're talking a little earlier, Christian, that I like to start these shows with trying to show that someone's a human being, but in your case you became a lawyer, so that's going to be a bit trickier than normal perhaps. I see you started university in Australia's Gold Coast, then you went to another university as if one wasn't enough perhaps, in Ontario's Golden Horseshoe, and now you're in London Fintech's Gold Rush. Is there a theme there?
To sort of try and prove that I am a human, I grew up on the Gold Coast, which was a very lovely place of the world to grow up.
Surely if you were a human, you would have stayed there.
Well, true. I mean, I did a stint studying in Canada for a while, and I think that's probably where I got a taste for seeing how, big the world is and sort of got the travel bug, so to speak. I sort of moved on from there and have been in London for a long time now and very much home to me. And I think, there's no more exciting place to be actually, given sort of the interest in fintech and everything that's going on.
So when did you move to London then?
I moved here twice actually. I moved here first in 2000, just after the Australian Olympics. And I worked as a lawyer in the city at Clifford Chance and then moved in-house with Deutsche Bank, which was a really great experience. And it was awesome to see law practiced at that level. Before that, I was a real estate lawyer in Australia. And so it was great, but also I think it was definitely a realization for me personally that I didn't want to be a lawyer forever. Working certainly in the big firms that you see, the Magic Circle firms, it's a certain sort of personality to do that day in, day out. And for me, it wasn't necessarily the best fit. So I moved back to Australia and basically got involved in the short-term mortgage lending space at that stage, and then was always keen to move back to London and set up the business here. So I moved back in 2008, which was good timing given everything that happened in 2008. Not
interesting times. I don't know whether you were very busy lending before or after the crash or simultaneous, but I mean, maybe we should come on to that later. But perhaps if you were, a bit like life, you never want to go through difficult times, but once you survive the difficult times, it sets you up in a way that other people aren't set up who haven't been through difficult times. I'm not a big fan of Formula One these days. I followed it for many decades. I've gone on to MotoGP, which is much more exciting to me. But I was very interested to see that Lewis Hamilton on Sunday, when he won the Formula One championship this year, was saying that for him, this second victory means far more than the first victory.
Yeah, I saw that, and that really resonated with me as well, because I think there is a lot to be said for, you think he's been world champion before, so doing it a second time is going to be less exciting for him. But I think there was such a hiatus there where he went through such a rough period that you could see actually he was visibly and vocally much more excited about it.
He was very moved. Yeah, no, exactly. So the first world championship, in a way, nothing had ever gone wrong for him. He'd been a golden boy, always on the up.
Easy run.
Life seems very easy.
Yeah.
And then, as we all find one way or another in all sorts of dimensions in life, people can have that for quite a long time. But sooner or later, life smacks you around the back of the head.
Yeah.
And you're on the canvas. And it's the fact that you can get up from that and go on to get where you were again, which is really the impressive triumph for the human spirit. I mean, maybe you didn't quite win the Formula One championship yourself, metaphorically speaking, after 2008, but nevertheless, there is some value in having been through that.
Yeah, definitely. And I think, when we set up the business in late 2008 and we saw everything that was happening in the financial markets, and we really thought it was an opportunity to, hey, let's be a short-term mortgage lender. That's what I'd done in Australia, teed up with a couple of guys that were, complementary in terms of their skill sets. But I think we didn't really see the onset of exactly how bad it would get. So through that period, we just sort of, we'll go and get a bunch of money and we'll lend it to people. But in reality, it was a really tough grind to get our first couple of investors. And so I often joke when I'm speaking at conferences and stuff that we had investors. Well, no, actually, we didn't have any investors when we set up. So it was a tough grind there. And yeah, it was sort of, in many respects, set the path that has led us to really setting up to where we are now. So it's been exciting.
Let's go on to Lendinvest later in the show. Firstly, maybe you could give listeners some kind of schematic insight into how it works. As we were discussing beforehand, the industry tends to focus a lot on the credit analysis that happens in the platforms, very understandable, very essential. But there are some bigger picture issues here, which I know that buddies of mine, including folks with 40 years experience in financial services, find that they're unanswered. So maybe a nice easy way into that is if you could just sketch out how the listeners could go off and set up their own peer-to-peer platform. What would they need? What components are necessary for them to have a business in months' time?
Well, I think maybe even stepping a step slightly further back in terms of looking at the landscape that has sort of led to peer-to-peer to come about, and I guess to be such a popular thing in the market. They talk about the evolution of peer-to-peer, and the sort of leading thought leaders in the US have now saying that peer-to-peer has evolved to marketplace lending.
Oh no, I'm just going to stop your great hypothesis. So we can disagree on this one. One of the things that I find that people find confusing are stupid technical terms. So peer-to-peer, to me, I associate with Napster. I give you something, you give it to a mate, they give it to someone else, that kind of stuff, which isn't basically what's tending to happen on these platforms. There's a central site you're going to. That's my first problem with peer-to-peer. I just like to call it online lending and borrowing, or digital lending and borrowing, or something simpler to the average man on the street, or even average man in the city, frankly. And then marketplace lending, I've seen that this phrase came along this year from a nice white paper by Foundation Capital, who are San Francisco VCs, and I can see that kind of from a VC tech perspective, the whole focus on marketplaces is really very generic, very important. I think TechCrunch did an article this week saying marketplaces are eating firms, but that's all a little bit, for me, too clever. Because it ain't really a marketplace in many cases. So that's the trouble with that one. It's not really either.
It is clever, and actually I think if you dig deeper, it's actually cleverer than what maybe even at first appears. So I think the real reason...
Is that a polite way of saying I've got it wrong?
Well, no. I think the reason people are wanting to talk about marketplaces is because it goes to the core valuation of those businesses. So, if you look at the valuation of Uber and businesses that are your classic, whether they're classic or not, they're sort of running off the marketplace tagline. And I think as a lender, the thinking is that if you look at the value of a bank these days, they're very much just a utility, and their valuations are not necessarily that stratospheric. But with peer-to-peer or online lending, you're sort of going for those sorts of valuations with Lending Club and those sorts of things. So
absolutely, I entirely get that, and I entirely get that the interweb is a very good way of connecting buyers and sellers of anything.
Yeah.
I really, really get that. At the same time, I do think that there are a number of differences between fintech and tech in general.
Yeah.
So I think that marketplace stuff, we're taking a tech phrase. There are a number of parallels, no doubt some far too subtle for me to get. But in terms of the fintech, one of the main reasons I don't like it is that it's not peer-to-peer. And as far as the UK is concerned going forward, I can't see tens of millions of, for example, lenders connecting directly with the borrowers as you would on eBay.
Yeah.
Without the intermediation of some professionals such as you who are really adding value in the middle.
I totally agree. And I think the point is not that we're distancing ourselves from, well, certainly, at Lendinvest, what we do, we try and go to the other extreme, but I don't
also
think even
parole rate setter or funding circle, any of these guys.
Out there, definitely like Funding Circle and so forth, they don't outsource the credit underwriting to the masses. But I think the point is they're not taking balance sheet risk. Yeah. So that's where the difference is in terms of, in terms of a sustainable business model that will go through different credit cycles. The thesis is that a marketplace will survive because borrowers on one side, lenders on the other, and each are bearing their own risk.
Okay, so I think that's definitely one for another show in the future. I'd like to debate that because one of the other things, we're getting a bit of a tangent here, but sometimes the tangents are more interesting. A chum of mine recently who was about 30 or 31, I was talking to him about risk and financial services and things like that. And I was talking to him about something from the 80s, probably before he was born, he pushed a point. And he was saying to me, "Oh, Mike, that's ages ago. That's not relevant, Yeah. At which point I smack my forehead and make the point that history isn't a guide to the future, but it's quite a guide. And the particular point that I was making was that I've seen at the head, heart, and gut level a number of asset categories in the last 30 years that have been really good value. Money pours into them. They're all being different ones. Money pours into them, and suddenly they're not such good value. And that's the thing you get just by having grey hair or no hair. You've lived through so many cycles of whatever. And of course, 30 years ago in the 80s, I didn't have a smartphone. 30 years ago in the 80s, there weren't peer-to-peer lenders. But that's not the point. If you abstract to a higher level, you're seeing the same old stories in the 80s, in the 90s, in the noughties, and potentially now going forward.
Yeah, and there are elements of we've seen this movie before with peer-to-peer. So it started off as people lending to other people.
Yep.
Now it's marketplaces. They call it marketplaces for those valuation reasons, but also because institutions are one of the main investors in this sort of space now. So if you look at Lending Club in the US, 70% of their deal flow comes from or is funded by institutions. And you see like P2P Capital, it's the fund that listed here with Marshall Wace in the UK, 200 million of institutional money there that sort of pension funds are pouring into and so forth. That fundraising was heavily oversubscribed. So I think there's a real appetite from institutions. And so you almost get to the point where these platforms, and in many respects we're happy for that to be the case, become deal flow origination machines.
Absolutely. So this is a big difference. And just for the listeners, in case they don't realise it, and Christian, you can fill in more on this one. As I understand it, in America, peer-to-peer is predominantly institutional. Therefore, to me, in America, the whole marketplace thing makes a hell of a lot more sense because you've got, for example, on the one hand, a hedge fund, which is perfectly able to look after itself. And on the other hand, a bunch of assets and they can get information on it. In the UK, and again, this is my reading, in the UK, and Zopa invented this whole thing about 10 years ago. In the UK, as far as I can see, and I think you guys are doing this given your credit losses have been zero. In the UK, I don't see it at the moment as being predominantly institutional, it's predominantly retail. And I see it having been designed as, in a sense, a substitute savings product.
Absolutely. Yeah, I mean, the UK government's very clever. I mean, I think they've sort of, they're openly...
Is it which one?
Well...
the current one.
Well, we're getting into politics.
And the next one as well.
I don't know if the next one's not looking like it will be that clever, but I think, they've created an environment where this industry can flourish, and they've been, very light touch in terms of the regulatory regime that's been set up. And we can come on to that because we think there's all sorts of problems with that, as opposed to the US where it's heavily, heavily regulated. And so there's actually only a few dominant players there. What has happened is, well, just sort of comparing the two markets, the returns for peer-to-peer investors in the US are much higher than what they are in the UK. So I think the crux of that is that the average saver is happy to take a 4 to 6% return on their money if they can feel comfortable that it's a relatively safe investment that they're making, or an investment sort of a savings type product. In the US, it very much is your institutions chasing higher yielding assets.
Yeah, and the likes of Prosper, didn't they do 12% a month in the past or something?
Well, yeah, exactly.
All this class action suits and this whole kind of stuff in 2008 and all kind of thing.
Yeah.
And we do have over here, again, my buddy I was talking about who didn't quite understand the peer-to-peer stuff, he mentioned Wonga, and I said, look, we don't talk about Wonga in polite fintech circles.
Well, yeah. I mean, we're a bit more real about it. I mean, I think Wonga's a serious fintech business, but coming back to the Prosper situation, I think how they previously did operate was they were largely outsourcing their credit underwriting. The borrower could put up all the sort of story about themselves, and it was much more of a social lending type proposition. Platforms have definitely evolved now. So, Zopa, Lending Club, and those consumer platforms, all of them are really targeting the highest credit quality borrowers in terms of FICO scores and credit scores here in the UK.
Right. So that's one of the big differences between the US and the UK. We'll come back to UK regulation in a minute. And so without us getting stuck down in the terminology, which is a perennial problem for this marketplace until we come up with something that the whole world agrees with, but I think it's very interesting to see what the differences are between the US and the UK. So coming back to the question, so if you want to go off and set your own peer-to-peer platform up, real estate or just peer-to-peer in general, you presumably need a mechanism for sourcing a bunch of funds and a mechanism for sourcing a bunch of deals, and somehow you connect the two.
You create a marketplace.
Oh no.
I think the reality is it's very simple to set up a peer-to-peer platform, and I think that's the danger of the regulatory regime that has been set up. So technically someone could set up a peer-to-peer platform out of their bedroom. And so the dangerous part to that is there is an environment that is very easy for people that perhaps are ill-intentioned or just grossly negligent or inexperienced to get involved in this space. And at the end of the day, we're talking about lending people's money. So, these people, whether they're ill-intentioned or even if they have the best intentions, if they don't, it's easy to lend money. It's harder to underwrite good credit quality loans and to sort of originate a volume of deal flow that's sufficient to sort of build a quality loan book. So I think on the face of it, it's far too easy. In terms of the main platforms, there's an ecosystem developing where things like the Peer-to-Peer Finance Association, I think, is sort of a self-regulatory body here in the UK that the best platforms are a member of. And there's things like that. So there's sort of best practices that are evolving. But at the end of the day, investors really are relying on the background of the people involved in those platforms and their ability to underwrite sensible credit.
So let's touch on this risk aspect because it's kind of key. And going back to my business development background.
It's everything.
It's everything, absolutely. I remember reading in the late 90s, I was a bit stuck at the time. When I had my own fintech in 1998, I used to have lots of good meetings with people and I'd always be very interested in that kind of stuff and it never seemed to go anywhere. And then I read a theory that if you're failing to make sales or you're failing to make progress, and the peer-to-peer isn't at the moment, but it's the same point, that actually what you've got is some underlying issue that isn't being discussed. It's a bit like if you're trying to chat up a young lady or a young lady's trying to chat up you and it ain't going somewhere. There's something in the background, maybe you're married, maybe she's married or something like that. And I think that, you've touched on it there. Let's just put the equity stuff to one side. You're not on the equity side, but I can say that privately, a number of people have really waved the red flag to me and say, be careful on the equity side because there are a bunch of folks around who don't have the integrity that they might have. And I have a friend who tried to raise some money on a platform this year. I won't even go into it. I'm not going to mention it, but got to be very careful on that. In terms of the peer-to-peer stuff, which is nearer to home for you, Christian, for the listeners, how can the listeners differentiate the good, the bad and the ugly of the peer-to-peer? Because they're not going to get the chance to know all the people. Is being a member of an industry body enough?
I think at the moment where the market stands, it's critical that people look at the associations that they're a member of. So on the equity side is the UK Crowdfunding Association. On the debt side, which is a different sort of organisation, but on the debt side, the Peer-to-Peer Finance Association. It's a much smaller body. I think there's like 150 peer-to-peer regulated platforms in the UK, most of which I would never have even heard of, and neither would other people. So I think they really need to do some sensible due diligence on the platform that they're investing in. So whilst they're investing in the loans that platform originates, they're really investing in that platform. Not in an equity sense, but they're really in their ability to originate quality deal flow.
Let's just drill into that, because again, it's a point of ignorance for me, of which I've got many, of course. I'm like a Swiss cheese inside my head. Let me say that I give you, for the sake of argument, $100. I know you don't take dollars and I know you don't take only 100 of them, but I give you $100. What actually happens to my money
Firstly, it goes into a segregated bank account.
Right, so it's not Lendinvest bank
It's not Lendinvest.
You fall over the day after I give you my money.
Yeah, and it's better than that because all of our loans are secured. So they're secured by a registered charge against property. Right. So if our platform fails or we fall away...
So wait a second, so just being precise on the language there, you say all of your loans are secured, but they're not Lendinvest loans, are they? Lendinvest originates loans?
Originates the loans, but then there's a charge that is held on the investor's behalf at Land Registry. Right. So that if the platform falls away, there's still recourse from the investor to that underlying loan. So it's a really interesting point here because we talk about savings products and those sorts of things. That, there really is a divergence in the UK market. So I think you've got platforms that are really, they remain core to the principles of peer-to-peer, which is transparency. That's another that's a really core fundamental principle. And so, Lendinvest adheres to that. So when you're an investor, you invest in our platform. First, when you put money on, it goes in an online wallet, which is basically, so if you put your $100 in, for argument's sake, you will be able to see that $100 there, sitting in Barclays Bank in a segregated bank account that we don't touch. And then you would select, there's a whole bunch of loans that will be listed on the platform and you can select the individual loan that you invest in. And you can click through, you can see the borrower's circumstances, you can see the property, the sort of dynamics and all of the, the reasons why the borrower is wanting the money and all those sorts of things. And you can make your own judgment. All of these loans have been vetted by us. We see 150 million a month in inquiries and we do a fraction of that for investors. But you can go in and you can select. So it's up to you. You might want to split your $100. We don't do it yet, but you could split it over 10 loans and you can apportion how much risk you want to sort of determine for that loan. Where there's many other platforms in the UK which are going the other way. They're sort of almost creating black box type products.
So your money goes into the black box?
Well, in terms of the mechanics of where the money goes, every platform does it differently. All of the main players will have segregated bank accounts, so I'm not suggesting anything otherwise, but it's more about the transparency point. So perhaps there's some platforms where you will log on and you will simply have, I'll lock my money up for 3 years and take 4%, 5 years and take X percent.
So that is putting your money into a black box.
It's a segregated black box in terms of the investors don't really, the investors have no transparency in terms of what loans they're buying. It's taking the savings product to an extreme. And actually, like we talk about, we've seen this movie before, really what that is that's just a fund. That is a collective investment scheme. It looks like one, smells like one, it is one.
And just to be clear, there's nothing wrong with that, as long as people are clear what they're getting.
No.
And just for myself, I'm a busy boy, I run around London and all that kind of stuff. I didn't have time to go and buy the individual loans, so it may suit me to stick some of my pension fund into some fund like that.
Absolutely, but the difference is it's not a fund, so the regulation is dramatically different.
So this is the key thing I'm talking about getting onto the risk. So coming back to the original point, drilling up a couple, you'd mentioned the point that people need to be careful about which peer-to-peer site. There are over 100 of them. Yeah. They're all doing things differently. There isn't one generic way of looking at it. But one of the key points that you're making is, do you as an investor invest in a slice, in a tiny percentage of specific assets? So let's take my $100 example. If I give my $100 to Lendinvest, it goes into a separate account with Barclays, and then I end up with, as I understand it, some charge at the Land Registry. So for the sake of argument, one Park Lane or something's being bridged by you guys, and I end up with 1/1000% of that mortgage.
Is that
my personal asset,
exactly
Mike Balliman's personal asset? Okay. As opposed to another model is I put my money in, it's effectively into some pseudo fund, let's call it a fund, de facto a fund, but not a regulatory practice, and then it's all pooled and you've got all the kind of fund issues.
The danger with that is, though, let's just say, for example, if it's a blind pool, the website can look and feel like it does short-term real estate loans like we do, but how do you know that that's actually what they do, and why aren't they prepared to give full disclosure and transparency on that? That's one issue. The other issue is, why are they peer-to-peer? They should just go and be a fund, because we operate funds, in our sort of business that we first set up. We've got 3 funds, and they're heavily regulated vehicles. I don't have to tell you, but, audited accounts, full transparency and accountability to investors in terms of what the underlying investments are. There's none of that in peer-to-peer, unless you select to invest in a platform that adheres to, the principles of transparency.
So one of the points going forward then, we're in an industry that's growing very fast. As I said at the outset, it keeps more than doubling every year. I remember hearing a talk by Zopa on how they invented the whole thing. And a bit like you saying that it's quite a hard job getting the first and second investors.
Yes.
So the whole thing has grown up quite rapidly. 2008 and following years, have changed the climate in financial services, etc. The whole industry needs to mature. And then from what you're saying, one of the ways that it may well mature is that some of these things may well, and probably in everybody's interest, their own as well as the investors, turn into funds, and some of them may turn into marketplaces.
Yeah, because I think there's a lot of hype around the peer-to-peer brand. So there's a lot of people trading off it, and they're probably trading off it very successfully.
Well, there's lots of hype going around because there are, IPOs in the offing in America and all that kind of stuff.
Yeah.
And, this is part of the big bad old FS, which is, I was talking to someone about this the other day. Way back in the day, a research analyst was somebody who gave you his view on a company. Then after a while, everybody realized that wasn't going to make any money. So 99% of the opinions became positive, and then 99.9% of them became incredibly hyped because the corporate finance division wanted to do a deal and sell something and all that kind of stuff. So there are these biases built in there. And I think this language is such a difficulty because, you've described what you do, but to me, the language, which I hear all too often, and I think that, you get this group think, all these conferences that people go to and just talk to themselves in their own language, and it makes a lot of sense to them, but the outsider thinks, hang on, so I'm not criticizing you or your language, but when I hear, oh, you put your money into the platform, I'm thinking about the www and the firm. I'm not thinking about segregated accounts. So you take your money to a fund manager. You don't give your money to the fund manager. It goes to custodians and all that kind of stuff who are doing custody of it. So.
No, totally, I agree. I mean, the UK government is behind a lot of the hype. You've got things like ISAs coming up, which is just a massive stamp of approval in terms of it as an asset class. I mean, ISAs at the moment can invest in cash or listed equities, and they're going to put peer-to-peer loans up on the same sort of pedestal as those. So in addition to that, you've got the UK government lending directly on these platforms. I mean, there's not much more they could do to actually try and sort of make people have some confidence in terms of this being the future.
At this point, I'm wishing we had a whole week to record this podcast because we could.
I know, it's a big topic.
We could do fair justice to a lot of these issues. So on the one hand, it's good that the UK is promoting alternatives to the banking oligopoly. We can see that makes a lot of sense, given that we all had to bail on the banking oligopoly out last time around. On the other hand, how they do it then starts to become an emotive subject. So whatever this British bank is called, it's invested in some platforms and not others. So then you question whether the government is intervening in the free market and skewing it one way or another. You've got the whole ISA thing, and I go cold when I hear that because on the one hand, lots of people get excited and say, oh, it's brilliant, there's going to be a tsunami of money. On the other hand, going back to having grey hair or no hair, I think, oh shit, here we go again.
Yeah,
what happens when a tsunami hits a small pipeline?
There's 400 billion pounds in ISAs in the UK, and so you've just got another huge wall of money chasing these assets, which the danger is, and a lot of these platforms seem to, and we're probably guilty of it as well, you sort of have your monthly volume and your sort of historical volume as your really, that's your badge of honor in terms of how much you've lent. So you've got a lot of, particularly for the junior platforms, trying to jump up to that. And how do you get volume when you're trying to lend money? You just loosen your credit criteria and you lend more.
I mean, I've seen all this thing about, we're the biggest lenders this month or this year, and, is it Zopa or is it Rate Setter and all that kind of thing. I mean, we have to get on to Lendinvest because time's going by. But just to share a story, the first time I heard of that, talking about the 80s and how it still is relevant. I was in fund management at the time, and when I joined Climate Benson in 85. And the sexiest part by far of Climate Benson in the mid-80s was North American banking.
Right.
If you were in NAM, as it was called, if you were in North American banking, you were the bee's knees. You were where it's at. And they got the biggest bonuses, they got the biggest kudos, yada, yada, yada. And I sat there being a fixed interest fund manager. And I recall in America, they were doing so much volume that they have quarterly parties and, depending on how much they'd done, and bonuses depending on how much they'd done. I sat there and I scratched my little head. And I thought, hang on, if you're a banker and you're chasing volume, surely the quality goes down. And I raised this point and I go, no, of course, we do superior credit analysis, we beat the marketplace, we're smarter, better, faster, cleverer, yada, yada, yada. Surprise, surprise, what happened? Give another couple of years, it all fucked up.
Yeah, the main platforms, we're talking what we think are big numbers, like Lendinvest, we've done over 170 million. That's very exciting since May last year, but we're talking the mortgage market. So in the UK, it's 1.2 trillion pounds. So there's still very small numbers. And I think, the established platforms, who are we to judge? But I know in terms of what we do, it's extremely sound and can run you through the background to our business. But our Montello business, we've got a couple of bank funding lines. And the last bank that actually gave us a funding line, they sent their auditing team in and they went through our processes. And they were a bit flabbergasted. Their head of credit actually said, you do a lot more than what we do when we lend. So I think for us, it is about deal flow origination, but it's really about trying to do credit assessment quickly, but not taking any shortcuts. Absolutely. Using technology to achieve that goal.
Using technology, and also people, let's come on to Lendinvest now. And I think, my message to the listeners, and also actually to people in financial services, a mate of mine was in credit, and he was asking me what I thought was his best future. And I said, look, you really want to be getting into one of the top 5 platforms. If you can get a job in credit there, those guys are doing credit better than the banks. Yep. They're nicer places to be, they're sexier, yep. They're doing it better, faster, etc., etc. And just finishing off the growth thing, to me, it's about managing growth. If you grow too slowly, you'll be stomped on by somebody else. If you grow too fast, it's like too much caffeine, sugar, or I'm mixing my metaphors here, like too much fertilizer on a plant which grows weak growth like a weed, and then it'll tumble over at some stage. So there's a growth profile that needs to be increased. Coming back to wearing risk hat, I always used to think about this in terms of how you could increase trading limits for a trader. If you're a foreign exchange trader, I'd be very happy to increase your limits 10 or 20%. I'd be very worried about suddenly giving you 10 times the limit. Yeah. So you're doing whatever, roughly 10 million per month at the moment or something?
Yeah, or more.
I can imagine you could do 15, 20, 30.
You could do a lot more.
Could you do 100 million next month without kind of, oh shit?
Well, yeah, we just want to force it out the door, but we can put it out, it won't come back. So I think, but like you say, we were both at the Lend conference recently, and there's a lot of groupthink and people sort of getting really excited about peer-to-peer, and that's great. But volume is not the only metric in which platforms should be based. The merits of it. You don't hear anyone talking about the profitability of a platform. A lot of platforms are just fueled by giddy VC money. Chasing the next big IPO, which is fine, and they'll no doubt make huge successes of that, and that sort of drives volume because that sort of is a big headline number and gets the journalists and the press excited. But what about profitability? What about a platform that actually makes money like us, and we've sort of grinded it out the hard way and haven't taken on external money? Just
pressing pause at that point, you've grown as a solid business and then gone digital, haven't you? A lot of other people have gone, oh, I want to do one of those, and they create a digital thing. Yeah. And just finishing on the growth point, because again, I think this is where fintech is very, very different from tech. In tech, if you're Facebook or something, you want to grow as fast as possible. There's no real downside to growing as fast as possible other than the computer falls over because too many people log in at the same time. In fin, as we were just saying, there is a problem of growing too fast because you can end up with some crap assets in the middle.
You could. We started off as a lender.
Exactly. Let's go back to your history. What happened before you were Lendinvest, which is very important?
So we set up, we had a couple of high net worth investors, and they would invest on a deal by deal basis.
About 2008?
Late 2008. And so that was great. We got a bit of a track record, but we couldn't really get any scale as a lender that way. So we set up a fund in early 2010. That original business was called Montello. We've got 3 funds, and we still have those 3 funds. And that really gave us a balance sheet and a way to sort of grow the business exponentially in many respects. But we always had investors that actually wanted to pick their own deals. They didn't want to invest in a fund manager, even though it was us. And so the other thing is we always had a huge volume of deal flow. And in many respects, in 2008, that was when it was the best time to be lending. And it was when no one was lending. As we get, the market gets better and better, arguably it's a less better market to be lending in. We were looking at the peer-to-peer market, or just looking for ways to raise capital. So we started looking at peer-to-peer. And with our Montello funds, we had given investors a fixed return of 8.5% per annum with quarterly liquidity. All of the loans were secured by a registered first charge against the property at land registry. And across the book, it was about a 60% loan to value. So we thought we'd created this really sound asset class. We're just struggling to get traction in terms of to get funds under management. We had sort of 20 or 30 million at the time, which was a great little business, but at the same time, the potential for it was so much bigger.
Yeah, people often think that if you do something that's really good, that's the secret to starting a business, but not really. That's just kind of the start. That gives you a headache, which is like, I've got this really great thing.
Missed opportunity,
And you know what? It could be much better, and that's really hard.
Yeah, and then we sort of were scratching our heads looking at the peer-to-peer market because, the unsecured platforms were offering investors a lower return, but they were doing it really well, really good technology platforms. And it just became very apparent that there's a huge swathe of investors out there that are looking for something to do with their money. So how do we tap into that? And then we launched Lendinvest. But in terms of the credit underwriting, the existing platforms in the market, so look at Zopa with unsecured and Funding Circle with SME lending, rightly so as well. They're very technology orientated because you can largely assess the credit risk involved with those asset classes in an automated way.
And just pressing pause on that one, my understanding of this, you mentioned the Lendit conference. My understanding of this is that, this is just my personal feeling, if I had to put money, then I'd stick it in some real estate backed stuff, because that's pretty good security, so that'd be my number one choice. My number two choice, purely from looking at the 10 years of history of Zopa, including the very difficult 2008, I'd put it in consumer finance because the loss record's been quite good. And then, as you say, Funding Circle, they say themselves that SME lending is rather harder than the other two to get right.
I think it probably is. So whilst it's hard, that's a huge opportunity. Absolutely. If they get it right, and it looks like they are. So in terms of us lending against property, it's right that we've come from the perspective of being a lender rather than a tech business, because you can't automate the underwriting for a mortgage. We still have to have an independent valuer go and look at every property. He has to take photos. He has to do a comparables report, all the sorts of things that sensible mortgage lending requires. In addition to the legal process, we will never get to the point where someone can make a mortgage application and just spits it out. There is a human underwriting element to it.
You are a real fintech. You've got to have the fin business, which is the guys out there doing the same thing they do if they had pencil and paper. They're doing the same thing just a little bit faster using the PC, but you also need the tech as well.
Yeah, exactly.
But there are lots of fintechs that are just kind of tech trying to be fin, and that's dangerous.
Exactly. And so I think in the property space, which Giles gave a presentation at Lendit last week or the week before, sort of saying that he thought the big scandal in the market would potentially come from property, and we had a bit of a joke afterwards.
You gave a presentation saying the big scandal would come from consumers.
No, actually, he knows where we sit on this, and we agree, because I think potentially the danger is people get involved in, again, chasing volumes. It's easier to get volume doing mortgages, because
as banks have found themselves.
Yeah, large sums of money, but it's easy to get it wrong if you just come at it straight from a tech perspective and think you can do automated valuations and that sort of stuff.
Yes, it's interesting going back to the difference between the US and the UK. As I understand it, in the US, maybe it's because it's got more of a tech inclination, they're much more driven by models, numbers and filters and automated robots investing in deals and all this kind of stuff. Whereas over here, I get the feeling that many businesses will of course have a model, but also they'll have a human being sitting on top that goes, nah, do you know what? That's what the model says, but
Yeah, I think it's fair to say that the UK market is far more conservative than in the US, and you've only got to look at the volumes. I mean, someone was saying, or they're predicting, Lending Club will lend $10 billion next year in a single year. So that's probably more than, well, it will certainly be more than the whole UK market just with one platform. So, but hopefully that has built the foundations for a more sustainable industry rather than just putting all of the faith in tech. I mean, we will get there eventually, but certainly speaking from our perspective, it's a real evolution.
So going back to that you are a fin and a tech compared to some of those which are more kind of just tech leaning, one of the constraints on your growth curve is presumably how many good people you can recruit. So again, going back to, maybe I chose the wrong numbers before, going back to, you may be able to do 2, 3, 4, 5 times the volume next year as this, but I would guess that you couldn't do 100 times the volume.
Mike, you're sounding like a VC.
Really?
You come in here all skeptical and pessimistic. It's true. And we make no bones about that. In terms of next year, we want to do a huge amount of volume, we're talking about that. But the way for us to do that will largely be boots on the ground. It'll be targeting the skilled operators we know in the mortgage market that will go and meet with people and talk to them about what we're doing. And it will be old school origination with a view to the bigger picture beyond that. But I think in the short term, in terms of our technology investment, it's in the deal flow origination and basically trying to make the consumer experience much better.
Just stopping on that, so deal flow origination, that sounds very sexy.
Technical.
What's that mean in English?
Basically, it means trying to have a nice website that a borrower would go to and feel comfortable applying for a mortgage on. Which at the moment is that's a mindset thing. So when people think of getting a mortgage, they think of going down to their bank.
But at the moment, you're only doing buy-to-let mortgages.
We're only doing buy-to-let. So it's actually targeting the mortgage brokers in the first instance, because they're key to the success here. And then also the other side to it is the investment in the credit underwriting. So again, it's trying to do more, but to do it in an automated way. So, we've got a whole team here and they sit there all day punching in borrowers' details, doing searches on properties and all those sorts of things. In the coming months, we want to basically have a pack spat out to a human underwriter where all of those searches are done in an automated way. So then that feeds into the consumer experience, because instead of waiting 6 months for a buy-to-let mortgage, we're already doing it in 2 weeks. We want to get it down to a matter of days.
That's fantastic, isn't it? And that really is adding value and being very disruptive.
Yeah.
Because if you go to a bank, it takes you rather longer than a few days.
There's no such thing as customer service, when getting a mortgage.
So, Christian, we've gone on far longer than any podcast so far, but I feel in some ways we only scratched the surface, although I hope that we've raised a number of issues that at least can direct people into the various topics they need to think about in terms of how much money they're going to stick into these things and what platform they're going to. Wrapping up on the sort of key points of Lendinvest before you give us a quick view of the future, what's the key thing here that we haven't touched on so far?
I think we've touched on most of it, actually. I mean, the key for us is origination, and it's the credit quality. That's where our investment in technology is. So it's not in this sort of fancy peer-to-peer stuff. The investors will come. There's plenty of money.
Peer-to-peer associations,
government money, all this sort of stuff.
He's going to kick you out after they hear this. They'll have to change their name or something.
Well, no, I think everyone, if they're honest, they're on the same page. I mean, it's...
peer-to-peer is so Napster to me. Anyway, whenever we change the language, let's not bog down that.
Yeah.
But one important business point that's implicit in what you say about your focus is on originating, let's just call it assets, and on credit quality. The implication is your focus ain't on getting more money into the platform on the left-hand side, as it were. Money comes in and it goes out into some asset.
Yeah,
You presumably got enough money already, or too much money?
We do. I mean, the biggest complaint we seem to have from our investors is there's not enough loans to invest in. Okay. So that's sort of one of the issues we are trying to address. Coming back to that marketplace model, I mean, that is the beauty of it in some respects, in that the beauty and the frustration that it is never perfect.
No, you also have too much supply or too much demand.
So that's just the nature of it. And we don't take our investors for granted, but we do think we provide a really superior sound product. So we're really confident in that. So really now it's working on the other side of it. And hopefully, we can sit here and we're in for the long haul. So, 10, 15 years time and just roll out a really impressive sound track record that beats any bank in terms of the way they've sort of put together a mortgage book.
And going back to what you started with in 2008, you will have at that point invented an asset class which both retail and institutional money cannot afford not to invest in. I mean, if you can return 5-6%, totally secured with bugger all losses, touch wood, who wouldn't invest in that?
Yeah, and in many respects,
that?
And we're disintermediating the institutions in many respects, because we're very different, and like a lot of the UK platforms are, we don't necessarily see our growth coming from huge institutions wanting to give us money. And in fact, we have tons of relationships out there with institutions that would really like to buy huge volumes of our book. But at the same time, the peers are more sensible in terms of the return they're prepared to accept. So an institution or hedge fund hot money is always chasing double-digit returns, where actually we can write a more sound quality loan book at maybe a 4, 5, 6, 7% return to investors, which is still a great return in this extremely low interest rate environment.
Great. Just to wrap up, the future. We've spoken about a number of the risks and things that could go well and things that could go badly. Where do you see it going in the next 1, 2, 3, 4, 5 years? And what's the kind of upside in terms of the rosiest scenario and the downside in terms of the, oh shit, it went wrong in 2016 because of X?
It could go a number of different ways. I mean, I think it could go in terms of the happy scenario. We have Lending Club, lists, they get their IPO away hugely successfully. The UK government stays very behind peer-to-peer. It stays a very light touch regime. We don't have any blow-ups, and there's a whole succession of successful IPOs and successful sort of mainstream financial services businesses in the UK. On the downside, we may have a number of companies that are lined up for IPO that really struggle. We're in New York recently, and it's really interesting talking to some of the large institutions, and people were talking about once these platforms list, they're getting ready to go short. Heavily short against these platforms because they're hugely skeptical. And, maybe that will come through. We may have some platforms blow up. In the UK, worst case scenario, we'll have a Ponzi scheme type operator.
Or some shops like Uber come in and try and sort of, once you're in my worry is like going back to the 1980s and the 90s and the noughties are still relevant, is I've seen this before. Whenever something's going good, you can always ring the bell when it's advertised in the Sunday newspapers with a big yield. Buy gold funds, they went up 1,000% last year. Yeah. Or buy this investment, it's got 12% return or 15%, because so many people just pile into the big numbers.
When the taxi driver's telling you, yeah. And so the danger with that is then that maybe the regulator will have a knee-jerk reaction to it. They'll go the other extreme. They'll either outlaw peer-to-peer, which again is extreme, or just make it heavily, heavily hamstrung, which could be good from a business perspective because it'll mean less entrants coming into it. But we want there to be a balance, and where do I think it will end up? I think probably somewhere in the middle there. I think it's a rough road ahead, but the long-term viability of the concept is very real.
Excellent. Well, it's a very good note to wrap up on, and I think if I could just abstract from that, what I take from what you say, which is that there's a wide range of potential outcomes, let's say over the next 3 years, is that there's a really important job for everybody to do. The companies, the platforms themselves to manage it all well, the regulators to manage it all well and evolve over time. So if the industry evolves into marketplaces and funds, then the regulation needs to adapt. The government to manage it well. And I would also add, in terms of the listeners, the investors to manage themselves well. I mean, I rather like the principle of the Roman Empire, although the regulators don't. Caveat emptor. If you're listening to this, well, don't just close your eyes and stick money in something on a sort of 3-year view. You've got to get into it a little bit more. I mean, personally, myself, the top 5, I'm quite happy to put money into the top 5 of you guys at the moment and shut my eyes for a year. And I think you'd be okay. But, who knows who's going to be coming in the future. So I think the whole thing needs to be managed. But I do think that there's a masses of potential here and lots of excitement. And in terms of Lendinvest, I think it's very much to your credit that given this opportunity to talk here, you're not just beating the drum, waving the flag, saying, rah, rah, it's all fantastic, it's all wonderful, but actually that up front you're flagging the fact that over there's an elephant trap, over there's some dodgy quagmire, there's a path through it, but you need to avoid the dangers. So I think that's to your credit, Christian, and thank you for spending so much time with you today, and good luck for the future.
No, thank you very much, Mike. It's been great to have this chat. It's been fun.
Thanks for listening. If you enjoyed the show, please subscribe on iTunes or your podcast app, or sign up at londonfintechpodcast.com for email alerts of new episodes. Live long and prosper.
We could sit in a bender all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moonrise, watching a happy moonrise. Come away from the city, with the tarmac so dead and the people so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fit in between the earth and the sky. Kiss the city goodbye, wave the city goodbye, wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight dance.